I'm Scarlet. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Skin in the game. Eddie Elfenbein actively manages his ETF with a fee structure that aligns his incentives with investors. Ken Fisher, the investor, the vulgarities, the fees. How the billionaire money manager is as old school as they come when it comes to selling funds. And going big on the big banks. How a steepening yield curve may be leading to more leveraged bets on financials. Whether you embrace or reject ETFs, they're here to stay, and their flows can often signal broader market trends. So Eric Balchunas gets us started with a check of the latest flows. Is there a theme that we can discern here?
Thank you, Scarlet. No, not really. In fact, this is one of the weirdest, most eclectic weekly leaderboards we've seen all year. Look at some of these products. You probably haven't even heard of some of these. That's broad market. There's junk bonds. Japan, what's that doing there? Mid caps. Then you got XLItes industrials. This is a buffer ETF. That's an interesting line, but that really has nothing to do with sentiment. Bonds. USMV, that's probably the only thing that you probably recognize. That's been on the leaderboard all year. This is the #1 flow getter. Let's look at outflows, though, for more of a clue into what's going on, because obviously last week was bullish. This week, not so much. In fact, more bearish, because look, IVV and the Qs are at the top. That's tech and S&P, energy. You've got some mid caps in there and momentum. So I'd say it's leaning bearish, but in order to really solve this, we created two new indices that we're going to show to you right now called Risk On and Risk Off. Risk On tracks ETFs that are like offensive factors and sectors, and Risk Off tracks defensive sectors and factors. And you can see here, Risk Off in October is kind of winning. It's been a lot of volatility to get there, but Risk Off is starting to take over Risk On. But really, the bigger takeaway is look at the sort of tug of war going on between Risk On and Risk Off all year, and the contrast between last year when Risk Off was clearly the trend. This year, every time Risk On gets going, Risk Off comes back. Scarlet, this is the theme of the year. Nothing is really taking over. There is no regime right now.
All right, so no clear narrative in the markets. Let's bring in Eddie Elfenbein. He is portfolio manager of the Advisor Shares Focused Equity ETF. And we want to welcome Annie Massa, who covers the asset management industry for Bloomberg News. Eddie, it doesn't appear that there's any clear consensus on whether to tilt growth or defensive. What's your take on leadership in a stock market that's near record highs and clearly in a late cycle economy?
Yeah, it's interesting. Nobody has sort of wanted to jump in front of the pack. And as soon as you think somebody does, they pull back. But I do think there is a case for cyclicals to gain momentum going into this year and into next year. Obviously, we got the Federal Reserve on the side cutting rates. Who knows how low they'll go? They may take a pause. But the key I'm looking at is the housing market. That has shown a remarkable level of resiliency. And while the housing market isn't the most important for the entire economy, it's the most important for the direction of the economy. And there are so many knock-on effects within construction, within consumer spending. So that's what I'm keeping an eye on. And that's why I think that we'll see consumers a lead towards a lot of the cyclicals, and maybe the defensive names will pull back on a relative strength basis.
Of course, we're also trying to sift through earnings and find out what the themes are there, Annie. It's a big earnings week, about a fifth of the S&P 500 coming out with results this whole period. The big banks surprised to the upside. The industrials, we're seeing that the drag of the trade war is really taking its toll. Tech earnings are picking up as well. What ETFs are you watching here in tech land to be most in play?
Yes, so tech has really been one of the better performing sectors this year. You see funds like the Qs and IGM up about 25% year to date. So as we move into earnings season, we've already had Netflix report pretty strong results, and you have some more FANG stocks like Apple and Facebook reporting next week. So investors will look for signs of trade war drag, and that'll be something they'll be watching.
All right, Eddie, let's dig into your ETF a little bit to get your take on the market, because you pick stocks, but it's rules, right? That's what your ETF is. Normally, when I think of stock picking ETFs, I see Amazon and Apple at the top, like especially mutual funds too. When you look at yours, I see stocks like Moody's, Sherwin-Williams, Hershey.
No tech names.
Yeah, really some interesting names on there. Why are they at the top of this fund of yours?
Basically, it's old school stock picking. I really like these companies. I think they have good moats. I like the management. I like their market niche, and also I like the price. As I think it's not what a computer spits out. It's old school stock picking, and my supporters and friends, we go through 10Qs and 10Ks and try to find out the best values.
All right, so due diligence the old-fashioned way. Now, your fund, CWS, is the first and only ETF with performance-linked fees as well. And this is something that Wall Street veteran Peter Krause, formerly of AllianceBernstein, has talked about. He said, the business has to be restructured so we can regain the trust of the clients. To do that, you have to align the fee structure with the client. I think the market will force the industry to change. Eddie, explain how your performance-linked fees work.
Sure. Basically, skin in the game. The better the fund does, the better it is for me. And if we trail, investors get a discount. So it's 75 basis point is sort of the neutral rate. And then on a trailing 12-month basis, our benchmark is the S&P 500. Mm-hmm. And basically, if we beat the market, then I get a little bonus, and I have this year. But if we fall short, as we have, it has happened before, then investors get a little bit of savings.
How much of a bonus? How much of a savings?
I get there's several different tiers. I don't have it with me, but it's roughly 50 to 1 for every 50 basis points that we beat the benchmark, not just a profit, but beating the benchmark will go to me. That's my bonus.
And Annie, talk about how Peter Krause's model, he's actually a company based on this. How is that different from that?
Sure. So Aperture has this idea that it's similar to Eddie's idea to link performance and fees for its products. So the idea there is really to kind of shake up the traditional model where you're paying a fixed rate on assets under management and align your performance with the fees that you're charging for investors.
A novel idea, if I've ever heard of one. Annie, this goes hand in hand partly with discount brokerages tripping over each other to offer commission-free trades. Everyone's looking for ways to save investors money and to get them to put more assets with them. B of A is now joining the crowd?
That's right. Merrill Edge was the latest broker to jump into this fray of charging zero commissions. And of course, they're following Schwab, TD Ameritrade, E-Trade, which all did similar cutting to zero of commission fees earlier this month. So it's basically a trend where investors are increasingly paying nothing to trade, and these companies have to come up with a way to make up the revenue somewhere else.
Eddie, I have to imagine you're just loving this, right? This is just a gift on your front door, right? So explain how this might benefit indies or smaller ETFs like yourself.
Well, I guess, this really is a true turning point within Wall Street. It's a huge victory for individual investors. And also it goes at, I think, sometimes the closed priesthood of the very large investment bank. It really is the barbarians are at the gate. We're breaking through. And this is it gives more visibility to smaller ETFs, different ways of investing, in ways that I think, frankly, are more investor friendly. I think this is a huge victory for the individual investor.
Our thanks to Eddie Elfenbein of the Advisor Shares Focus Equity ETF, and of course, our Annie Massa. Now coming up, New Hampshire is the latest state to pull out money invested with Ken Fisher, bringing the total amount withdrawn to more than $2 billion. Next up, we take a look at the firm's holdings and exchange-traded products. And one ETF group that caught our attention this week, water-related ETFs attracted more money in the 9 months through September than in any full year since 2007. Investors starting to pay more attention to global water shortages because of climate change. A reminder, you can find that chart and all the others that we feature on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. Now let's take you through the ETF Lifecycle, which has 3 main stages. Step 1 is the filing, and First Trust teams up with Vivaldi Asset Management to register a merger arbitrage ETF. Ticker MARB will be actively managed, taking long and short positions in companies involved in deals. Step 2 is the launch. The Global X Cybersecurity ETF begins trading this week. Ticker BUG will invest in companies set to benefit from the growth in security protocols for networks, computers, applications, and mobile devices. It'll be the 4th cybersecurity ETF listed in the U.S. And for some, the final stage is liquidation. The Granite Shares S&P GSCI Commodity Broad Strategy No K1 ETF, that's a mouthful, is shutting down. Ticker COMG launched back in May 2017 with exposure to broad commodity futures, but failed to attract assets beyond $8 million. Time now to get passive aggressive, where we track the tensions between active and passive investing. For decades, billionaire Ken Fisher branded himself a gifted stock picker, and it worked. Investors happily paid hefty fees to get into his funds. But a string of vulgar comments changed everything, and Fisher's empire has now taken a few hits. It's a cautionary tale of one active manager in this day of cheap passive funds. Bloomberg News reporter Sabrina Wilmer joins me now with more. And Sabrina, you wrote this incredible report detailing the hardball sales culture of Fisher Investments, which is a real contrast to the soft sell focused ETF issuing registered investment advisors that we typically have on the show. Take us inside Ken Fisher's empire, which, to be honest, reminds me of like the boiler rooms of the 80s and 90s.
That's right. I mean, they hire a lot of kids right out of college, and they basically go on the phone. They sift through this database of people throughout the country that have clicked on these ads and filled out information, and they have to call hundreds of people a day and sort through a bunch of unqualified people. Sometimes they're calling the same person multiple times because once you fill out information, you're kind of stuck in that database forever. So it's an intense culture, and there is a specific time that they have to get in and leave. Very, very structured approach.
Okay, so it's definitely, you paint this incredible picture here. Most registered investment advisors that preach low cost typically invest in index funds or ETFs that charge, what, 5 to 10 basis points? Right. Fisher does it differently. Can you give us a sense of how much he charged?
Yeah, he charges for private clients 1 to 1.5% at the most.
Wow. Okay.
And that's even more than an active equity mutual fund.
So it sounds like he was essentially a stock picker or, like you said, an active mutual fund manager. What does his performance look like?
It's a little mixed. They gave me some performance numbers, and some years are better than others, and they use the MSCI Global Index as their benchmark.
Okay.
And they've, over the past 3 to 5 year time frame, they've beaten that slightly. But if you look at a 10-year time frame, they've missed their own benchmark. And even since the financial crisis in the bull market, most of the years they've missed that particular benchmark. And it's even worse compared to the S&P 500.
Interesting. Now, Fisher has been getting hit on the PR side, certainly from the comments that he made at a conference, but also on his client base. Who's pulling money out? How much have they pulled out?
So far, what's been reported has been more than $2 billion. And really large, well-known investors have pulled out. Fidelity pulled out $500 million. New Hampshire pulled out yesterday. We're keeping our eyes on some other big institutions like Goldman Sachs and state of Georgia, which has a more than $2 billion investment in Fisher. Okay,
so you'll be reporting that if and when that happens. What strikes me is when you first started reporting this Fisher story, and you talked about his sexist, sexual comments, the graphic comments that he made, he seemed kind of surprised that there was so much fallout from it. Like he said that this is stuff he says all the time. Is it starting to sink in that it's different now?
I think it's starting to sink in the more clients are pooling money. I did catch him on the phone right after some of those news stories came out, and those were his comments that a lot of what he said was true, but people weren't getting his point. And that he said this a lot of times in the past, and he just didn't understand why people were reacting in that way.
Well, maybe because times have changed, being the first reason why. Let's just connect everything back to ETF IQ for a moment here, because many people probably don't realize that Fisher has a line of ETNs, exchange-traded notes, that are actually pretty big, 4 of the 5 biggest on the market. And by the way, the FI in those names actually stand for Fisher Investments, not fixed income. Tell us a little bit more about these ETNs.
Well, what Fisher said, why they use them is to help create liquidity for clients so they can move in and out of their, accounts pretty easily.
Okay,
so that's the main reason that they're saying they use them.
As part of that active manager strategy, then.
Yes.
Sabrina Wilmer, thank you so much. Sabrina Wilmer, reporter for Bloomberg News, who has been writing about Ken Fisher. Now, coming up, we dig into one global infrastructure ETF that offers exposure to the whole ecosystem, from pipelines to utilities to transportation. And for a drill down into all of Bloomberg's ETF content, check out bloomberg.com/markets/ETFs. This is ETF IQ on Bloomberg. I'm Scarlet Fu. This is ETF IQ. Now, for every ETF that offers exposure to a sector or a strategy, others are usually quick to follow suit. A move higher in bond yields since September is giving new life to the beleaguered banks. And Shares has a series of leveraged funds targeting that segment. Rex President Scott Asaychek joins us now to tell us more about their microsectors funds. But before we get to him, Eric Balchunas is going to give us the drill down into one of the funds, which is BNKU.
Thank you, Scarlet. I'm going to go ahead and nickname this Bank U because I like to. It's the big banks index, and listen, it's an ETN. That's one thing you need to know. There's a moratorium on leveraged ETFs, but you can launch leveraged ETNs. So they've come along and said, hey, why don't we go a little deeper into the leveraged space and do a little more of a pure approach. So, you know, when you hear about bank earnings, this is trying to say, hey, let's play bank earnings and not all of financial. So it's expensive, but so are all leveraged products. Still pretty new at 30 million. Oh, that's pretty big for that. But again, that leverage 3x is the big thing you need to know. Let's look at it compared to the two other ProShares and Direction Financials leverage ETFs. And what really sticks out here is the bank exposure. Obviously, way higher here, a little lower here. And this has some diversified financials like Schwab as an example. And then here you're going to have insurance companies. You have none here. So you can see that you're just going pure towards the bank play here, and also pure in the number of stocks, only 10. So again, more juice here for the bank play. Now, let's look at the past few weeks because banks had a good earnings. So you would hope this popped more, and it did. You can see this is the Bank U here, and this is the other two here. So because you didn't have the other financials and insurance companies, this was able to go a little higher. But again, what goes up can come down. So again, Scarlet, you know, I like to call these power tools. Really should be used by professionals, but it's interesting innovation on that line.
All right, still with us right now, Scott Asaychek of Rex Shares, and Eric calls them power tools. They're only to be used in certain occasions in that they're short-term investment products. They're not buy and hold products. Do you tend to see a pickup in interest and activity around these leveraged bank ETFs during earnings season?
Yeah, absolutely. So we only launched these recently, so they are starting to gain some popularity, and we're really trying to get our name out there. But the whole goal there, like Eric alluded to, there's a moratorium on new ETFs coming out that are levered and inverse. But there's also a moratorium on innovation in the levered and inverse space. So what we're trying to do is use that ETN wrapper, kind of create what we think what people want. When you're trading around bank earnings, I'm not sure you want 254 holdings that include insurance companies, REITs, exchanges, credit card companies, banks, regional banks. I think you're looking for more of a pure play, and that's what we're trying to do here.
All right. Also, the steepening yield curve, the 2-10 spread widening since late August that we have right now is another theme that gets people more interested, more excited about banks as well. That's got to make your ETF more attractive to them, too. Absolutely.
So there definitely is a sentiment, and there's definitely a lot of talk about bigger banks being in better position than regionals as we kind of go forward here in this space.
Now, you have another one, the biggest one, if that's Bank U, this one's Fang U, which I'm not surprised is the most popular.
Which you coined again, too, because we don't know if anyone calls it.
Somebody's got to do it. So this is not tech, but just Fang plus a couple other companies that are in that Fang world, like Tesla, et cetera. So talk about this one in terms of why you tended to do it. Obviously, we've had other guests on talking about the difficulty of actually playing Fang through an ETF because you have to take other things with it.
That's right. That's right. So when you look at Fang, and actually let's say you spell Fang with 2 A's. So you get the 5 names in Fang. That's now, because of the new GICS classifications from the last couple of years, that's now in 3 different sectors and 3 different categories. So you have Facebook, Netflix, and Google sitting out there in communication services. Right. You have Amazon in consumer discretion, and then you have Apple in Tech Select. Now what's interesting about Apple being in Tech Select, that's by far like the ticker. That's what people think about when they think about tech is Tech Select, but it's also joined by Visa and MasterCard in the top 5 holdings, which makes it really interesting, right? Because I think the whole world of tech investing, not just from GICS, but also the evolution and maturation from the NASDAQ 100. So the NASDAQ is an index out there. People refer to Qs. There's triple lever Qs, which is the big boy out there. That is the 100 biggest names that are on the NASDAQ 100. So top 25 holdings include Pepsi, Comcast, Starbucks, Costco, names along those lines. And yesterday, what really took the news was Hasbro. Hasbro got destroyed yesterday, and I was kind of interested to see. Hasbro is actually a NASDAQ listed stock as well, so it's in that NASDAQ 100, albeit a little smaller, but it gets a lot of fanfare for that, but it's not necessarily what I think of true tech.
All right, so when you look at all these leverage funds, if you were to look at the long-term performance of the microsector's big tech leverage funds, and I know you're not supposed to because, again, these are short-term trading tools, both are down by quite a bit since their launch, but again, people tend to get out before that happens, right?
Yeah, so they're both down. Have you figured out how to, in a sentence, explain to a retail investor why that happens. We call it daily resetting, but how would you explain to retail why they're both down over 18 months?
It is daily resetting. That's exactly. So the trend very much is your friend in the levered and inverse market. So when you have a choppy market, then yes, you start to get hit by that daily resetting.
Very quickly here, we mentioned that these are ETNs, so there is credit risk involved.
That's right.
Talk very quickly about how ETNs work.
Yes, so ETNs are issued by a bank, so they're a bank note. Banks are promising to pay you the performance, in this case of big banks or maybe big tech. So they're on the hook for providing that performance, but the interesting thing there is that there's no slippage, there's no tracking error. You're getting the performance of the banks or tech minus the fees.
Got it. And you used to have leveraged VIX products, if I remember correctly, but you're now focused on sectors. Why the change?
Yes, I think a lot of the world has changed in the VIX space after February 5th of a couple years ago. So we kind of repivoted our focus and put it out there on the ETN side, focused on the building out FANGs and big banks.
Yeah, VIX may be a little bit too hot to touch right now. Thanks to Scott Asaychek of RexShares. Appreciate it.
Thank you.
All right, we like to say the ETF industry has something for everyone, including those who believe all that public spending plans or promises of spending in infrastructure will soon bear fruit. So check out this week's There's an ETF for that. The Ishares Global Infrastructure ETF is known by its ticker IGF. The fund builds off investor appetite for global exposure to mainly large-cap infrastructure companies. Its top industry groups range from electric utilities to engineering and construction firms to pipeline operators and transportation names. The fund weights these groups by market cap. There are some 75 companies, including Aena, Enbridge, Transurban, NextEra Energy, and Atlantia. Together, they span the globe from North America to Europe and to Greater China, New Zealand, and Australia. The fund has amassed more than $3 billion in assets, with an expense ratio of 47 basis points. Since launching in 2007, IGF has returned around 40%, which pales in comparison to the S&P 500. In the past year, though, IGF has easily outpaced the U.S. benchmark. IGF gets a green light in the Bloomberg Intelligence traffic light system, with one warning for its tiered weighting system. Feels like infrastructure is a promise that just doesn't seem to pay off.
Yeah, it's a great story. For people thinking about infrastructure spending, if we ever get a bill, PAVE is actually better because it's U.S. only, and a little less utilities because you get rate risk with utilities in these infrastructure ETFs.
Yeah, of course. Well, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.